19.1 is talking about buying plant assets and paying property taxes. We have 3 learning objectives. You need to be able to record the buying of a plant asset. You need to be able to analyze the cost of individual assets bought as a bundle, and you need to be able to calculate and record the payment of property tax. Return on investment, ROI, is really the ratio of money that's earned on an investment relative to the amount of the investment. So what we're looking at here is the amount of money that we are investing versus how much money we will receive because of that investment. The more efficient the investment, the higher the ROI is going to be. And we really want to look at this, or anyone that's making business decisions, because this will help them make the best decision on what assets they should be buying or investing in. So recording the buying of a plant asset, this should be easy. We've done this before. January 3rd, we paid cash for a shelving unit, $8,500, check number 612. We're simply going to increase store equipment with a debit of $8,500. We're going to credit cash with or for $8,500. Since we're using a check, we're going to go into our cash payments journal, debit store equipment, and credit cash. Now, what's new is when we're buying a group of assets. So to calculate the total estimated value of all assets bought, first we're going to do some estimations. So when we look at, in this example, we're buying 2 assets for one price. So we're estimating that one of the assets is $7,500, and we're estimating the second asset is $22,500. Okay? So a total, remember this is an estimation, would be $30,000. Now we have to figure out what cost we're going to assign, because when we're recording this into a journal, we have to have a specific cost. Okay, so when we look at asset number 1, they're telling us that asset number 1 is a copy machine. We estimated that it was $7,500, and we estimated that buying our 2 assets together would cost us $30,000. So we're going to simply divide those 2 numbers, and the percentage then would be 25%. Okay, then we're going to look at how much we actually paid. So when we look at how much we actually paid, we only paid $27,000, and we're going to multiply that times the percentage that we figured out, and that is the number then. So 27,000 times 25% is 6,750. That is the amount that we're going to assign to asset 1. Then we're going to look at asset 2, which is a display case. We estimated that one was worth $22,500. Our estimated value of both of them was $30,000. So again, we're going to divide. This percentage then is 75%. Again, the total price that we actually paid was $27,000. So we're going to take $27,000 divided that 75%. And the cost that we're going to assign to that display case then is $20,250. So it says on March 5th, Dufour Company bought a copy machine and a display case for $27,000, check number 234. Now, when we were recording this, we can't record this simply as equipment for $27,000 because we have 2 different pieces of equipment in there. So that's why we had to figure out how much goes to each piece of equipment. So in this case, we're going to increase our office equipment by $6,750. We're going to increase our store equipment by $20,250, and then we're going to decrease our cash by $27,000. Now, this would go into our cash payments journal, and we don't have our picture for that, but it would go into our cash payments journal because we're paying cash. Okay, so some more definitions. Real property, or a lot of times what we're going to hear it called, would be real estate. That's going to be any land or anything that's attached to that land is called real estate. Personal property is all property that is not classified as real property. So anything that we would have in a house, the house would be real estate, but anything that's in that house would be personal property. The assessed value is the value of an asset determined by tax authorities for the purpose of calculating taxes. So what they do is, for houses, for example, they're going to give you an assessed value, and that's the way that they figure out how much taxes you owe on your house. Assessed value is usually based on the judgment of officials referred to as assessors. So the people that figure that out are called assessors. So what they're going to look at is the assessed value times the tax rate. So here our assessed value is $80,000. The tax rate is 1.3%. So that means the annual property tax is going to be $1,040. So what we're going to do to record that is we're simply going to debit our property tax expense and we're going to credit cash. Again, we're paying cash, so that's going to go into our cash payments journal. We're going to debit property tax expense and we're going to credit cash. All right, number one, which accounts are affected and how when cash is paid for office equipment? Office equipment is debited and cash is credited. Number two, why must a cost be allocated to each asset bought in a group? This is so that we have a price for each plant asset so that really when we're depreciating it, we can figure out how much each plant asset depreciates individually. And number three, what items are included in real property? Real property, or remember it's called real estate, is land and anything that's attached to that land. That is the end of 19.1 lecture. Go ahead and go to the 19.1 work together.